Hello, everyone, and welcome to another episode of the Smart Money Show. I'm one of your co hosts, as usual, Ali Suleiman, and I'm joined by my other co host and co founder, Naman Akhtar. How are you, bro?
I'm all good. April's come to an end now at the time of recording, and just exams are right around the corner. So just focusing on those. What about yourself? How's things going?
Yeah, same old stuff, just prepping for kind of my internship in summer, prepping for exams and everything, just
Hmm.
same old stuff. You've come off a few spring weeks, so it's kind of feels like the academic year's taking a wind down. But as
Hmm.
you said, it's the end of April. We're at the end of Q1. So, what
Yes.
have we got lined up?
Yeah, so as you may know, if you guys watched us before the rebrand, then you know that every month we do a monthly recap episode covering key macroeconomic events, specifically targeted at equities and cryptocurrency. And for that, we have our own resident experts, Ilett and Jeremy Okornoe, who are experts in equities and crypto respectively. So they're going to be helping us break down a few topics today. So without further ado, how are you guys doing?
Yeah, I'm all good. Glad to be back.
Yeah, very good, thank you. As Ali said, sort of prepping for exams and getting ready for the summer internship. So it's been quite busy, but it's been a nice break over Easter at the same time. So yeah.
Completely.
Yeah, no, 100%. And topics wise, there's just been so much interesting stuff happening over the past couple months. So we're going to try cover as much as possible, but with a more focus on April. So to give you a list of the topics, then, guys. So today we're going to be covering. The topics we're going to be covering is US economic data and UK economic data, then the S&P versus Bitcoin performance, FTSE versus S&P performance, Trump tariff news, crypto news regarding the Bitcoin strategic reserve, Trump versus Powell, statistical data for BTC, and we're going to finish off with some bank earnings. So a lot for you guys. So Ali, do you want to kick things off then with the first topic?
Yeah, 100%. So, as Naman said, for those of you who remember our old episodes, we always start off with macro. Always, it provides a good foundation to the whole episode. So, we're going to kick up things off with US economic data, and this episode is going to be not just a recap of this month as usual or April, but it will be a recap of the kind of the whole first quarter of the year as well. And then we'll move on to monthly recaps from then on in the next month or so. But Jeremy, I'm going to come to you first, but we'll go to you both for the US economic data. Let's start with the US. What's the big picture story from Q1 economic data in the US?
So yeah, it's been a roller coaster. Volatility's been actually one of the highest in a very, very long time. Looking at the VIX in particular, which is the volatility index, it's inversely correlated to the S&P and Bitcoin, of course. So that had a massive, massive spike, and of course we had an insane correction. So we need to be looking at the data to be understanding what's going on under the hood, essentially. Um, yeah, so we can immediately go and just look at the consumer spending, and we can see consumer spending already slowing, and of course this comes off of the back of rates remaining very high, and just the topic of rate cuts. We have, of course, the tariffs that's tried to counteract the rate cuts. So essentially, that's the games that's been played the whole of 2025, and that's kind of like a quick summary. But just to delve into a few more metrics deeply to just get an understanding, especially what's going on recently with the GDP numbers that came out yesterday. So for inflation, so core inflation, it's just been rising at about 0.3% on average monthly and about 2.6% annually. So of course, with inflation rising, it doesn't really incentivize Jerome Powell, Fed chair, to really cut interest rates. So of course, it begs the question: like, will the tariffs continue to be employed on different countries to kind of force the Fed's hand, essentially? And I'm sure we'll talk about that, as Naman mentioned, a bit later in more detail. But looking at, of course, the effects on the markets, it's just been very, very choppy. We had a big correction off of the tariff news, and of course, just in general, the markets haven't really been as volatile after that. It's just been kind of pricing in these things. I guess the kind of narrative with inflation and interest rates has been a topic that has not just surfaced right now. It's been kind of the topic since around last summer, where the Fed
Hmm.
still decided to maintain high interest rates. In summary, essentially, that's kind of the macro overview of what's going on. We have still the topic of interest rates against tariffs, and um, we have inflation rising. So we need to kind of look in towards the next FOMC meeting and the next CPI reading to, of course, see if anything changes.
Oh, wow, it does seem like the US are tired of winning, aren't they? So, I mean, Dylan, anything to add? Maybe any particular prints that you want to talk about, which really shifted sentiment in the market?
Well, yeah, I suppose sort of the sentiment that Donald Trump's given, really, I mean, when he first sort of got elected was, straight away we're going to see benefits in the economy. And, it's almost the opposite of that. Like, for example, as Jeremy said, in terms of GDP projections and GDP growth, the US economy contracted in quarter 1. And obviously, that is a long shot away from what Donald Trump has promised. And I think, alongside all of the diplomatic issues that he's had recently, the issues that he's had with Powell as well, which we'll get onto later, it seems that the US is in a very volatile sort of position at the moment. And for me, in my opinion, it seems that there isn't really a short-term fix to this or a way out of it. I think we'll see inflation continuing to rise unless something drastic happens with his tariffs and economic policies. And everyone knows watching this, Trump is as stubborn as he is. So that won't exactly happen in the way that probably markets want it to. Listeners are aware of how stubborn Trump can be, especially when it comes to his economic policies, and I think we're a long shot away from where we need to be to see positive signs in the market. And unless there's a drastic change, as I said, I think that there's only more bad signals to come.
And sort of last question on this topic. Did anything kind of surprise you guys in Q1 when it comes to US, or go under the radar, anything that went under the radar that you think deserves more attention, that because there's so much stuff happening, the media's kind of glossed over, or students and finance professionals aren't really thinking about? That's to both of you, whoever wants to jump in.
I just think observing Trump's tune, that was very interesting. Initially, he was very kind of he came out as some sort of bully. He was setting a tone. He was kind of dictating the rules against his terms, right? But recently, we've kind of seen him kind of come back with his tail between his legs and just kind of understand that there's repercussions to some of the decisions that he has made. There's been a lot of news that I'm gonna be kind of going over in a few minutes, but yeah, like just kind of looking at everything from this month, especially Trump is kind of realizing that to really kind of incentivize Powell to kind of bring down interest rates reasonably, he has to kind of make sure that the future is kind of predictable in a sense. It can't just be um, uncertainty around all the time. There just can't be uncertainty. We kind of need to know what's going to be happening because the Fed is kind of learning every day as new things come out, right?
Yeah, no, 100%. But I think, Trump's whole way that anything goes wrong, you can just blame Jerome Powell, I think.
Or Biden.
Or Biden. It's,
Yeah.
it's a really strong strategy. But moving on to UK economic data. So, Dylan, I'm going to start with you on this one. What's the UK looking for Q1? And what's the state of the UK economy?
Yeah, so really, I suppose looking into the future before we get into current data, there's quite a sort of bleak outlook for the UK, sort of accompanied by the US, and that is because, first of all, markets are connected, but also Europe will definitely feel the brunt of a lot of these tariffs. So the IMF actually reduced its forecast for GDP growth in the UK to 1.1%, down from 1.6% for 2025. And we spoke in previous episodes before the rebrand about how we were hoping for a real positive sort of outlook for the UK coming in 2025, and it hasn't really happened. So, for example, consumer prices index stands at 2.6%, which is away from the Bank of England's target. And inflation's actually predicted to reach 3.1% in 2025, which, it's almost like a repeat of a couple of years ago when we're starting to see major increases in inflation. And obviously that's caused the Bank of England to sort of retain its interest rates. And, we know the issues with that. So, it's a mix of obviously Trump tariffs, but also high spending in the UK in terms of government spending. I don't think the UK entirely have their sort of issues in matter at the minute. I don't think they have got anything under control at all. So it's quite a bleak sort of outlook for the UK at the moment, sort of accompanied by the US. But I mean, inflation's started to rise again, and it's projected to rise even more. Interest rates are staying stable. We're waiting for a Q1 GDP update. I believe it's coming the 15th of May. But again, that will probably be a contraction. Not entirely sure, but if we start to sort of price in and look into what's happening with tariffs and the price of exports, most likely there will be a contraction. Because the thing is, as well, a lot of UK companies, the majority of their revenue comes from the US. And this is something that a lot of people don't really realise. A lot of our revenue comes from the US, and they're one of our main trade partners. So obviously, when we're talking about UK domiciled companies here, especially in FTSE 100, it's only bad news unless we have a suitable trade deal with the US. So it's, again, sort of following on from the US, it's not a great outlook. But I suppose one thing to say sort of positive about is the UK stock market. And so far, that's returned 3.8% year to date compared to the S&P 500, which has actually declined by nearly 6%. So it appears that I always go on about how I think the UK is undervalued and whether the investor sentiment reflects it. But it appears that a mix of sort of undervaluations and the volatility in the US. And I think another thing as well, investors. It's crazy sort of how investor behavior works, but just because they don't like Donald Trump, it's almost given a lot of the investors a reason not to invest into the US. And obviously, what's the closest alternative if you're a UK investor? I suppose it's your home domestic market. So the FTSE's performed relatively decent this year so far, despite the troubles that we've had in the global economy. So it's, again, mixed signals, and I suppose we're going to have to wait and see what happens.
Yeah, I think it's crazy to think about how if just because people don't like Trump, they're not investing into the US, but it's the world we live in. Sort of last question to you on this topic, and I'll come to you, Jeremy, for a little bit as well. Were there any sort of sector-specific standouts in the UK that you feel are holding up the economy or kind of dragging things down, or just something that's actually, maybe withstanding the sort of whole macro economy?
Yeah, so I suppose the sector that's almost holding things up is banks, and obviously we'll get onto that later. We know that banks like high volatility and almost in a position where the higher the rates, the higher they're going to benefit from their net interest margin. Sectors that have struggled, I mean, consumer spending's actually increased over the past quarter, but I'd say the sectors that have struggled is the manufacturing sector, and obviously that is likely to happen. Obviously, we've had the issues with the steel industry as well. So it appears that the manufacturing sector in the UK has sort of struggled a little bit, and that's an issue that needs attention to be paid upon. But yeah, so really it's the banks that have been holding the UK market together with their strong earnings, and sort of manufacturing or even house building sectors haven't had too good of a run this year so far.
Really interesting. I mean, even at my Springs, they were saying everyone who was within trading, they were just saying that like these sell side banks, they were just saying that it's completely hectic, so hectic in the past few days, or the past few weeks, sorry, because it's just like every single bit of news has got so much effect. And as you said, they drive on volatility, don't they? But yeah, Jeremy, anything else to add?
So nothing too much, just regurgitating what Dylan said. Just looking at the UK inflation in particular to just kind of understand if they're gonna kind of cut rates before Jerome Powell, as Jerome, of course, is always known for acting a bit too slow. But yeah, we can see that inflation is still rising in the UK. So of course, if you're having lower growth and higher inflation, that's of course stagflation, which is very very bad. And typically, like if you look at the recovery period after, it's something that can't be solved quite quickly. So of course, as inflation is persistent, I think the Bank of England will definitely monitor the changes in prices to kind of understand if they need to kind of cut interest rates, and maybe that would force, well, not force, but incentivize kind of Powell to cut rates if other countries are continuing to cut interest rates. So I guess that's one key observation when looking at the UK economy.
Hmm. Well, we're going to touch a bit more on interest rates later on when we talk about Trump versus Powell and that sort of lack of camaraderie that's going on, which is obviously very dramatic to watch from an outside perspective. But Jeremy, we're going to stick to you with you to talk about S&P versus Bitcoin performance. So a very general question, but take it however you want. How did Bitcoin stack up against the S&P in Q1?
Absolutely destroyed the S&P 500.
Should we just end
Bitcoin
it there?
is number one. Bitcoin is the number one performing asset at the minute. Other than gold, of course, you can look at gold. Gold's been soaring, but other than that, Bitcoin is literally destroyed the S&P, honestly. So if you look at the S&P divided by Bitcoin divided by the S&P, sorry, you can see it's just higher highs, higher lows. Bitcoin's just been holding up very well, and if you just look at the gains the S&P gave back on this correction, it actually corrected the whole election rally essentially, and Bitcoin is held up well again. So it begs the question: is Bitcoin lagging the S&P? This is something that can be on the table where, of course, Bitcoin will have to kind of start to underperform, and the S&P kind of catches up to where Bitcoin is, or it might be the latter where Bitcoin has kind of um, lagged the S&P and it's going to come down. I think Bitcoin is just generally exercise some strength. We're seeing ETF inflows. So of course, in the past about 12 days, there's been about $42 billion of Bitcoin being bought by BlackRock. We're seeing a lot of institutional demand. We're having I'll go into that in the crypto news actually when I talk about the strategic reserve. But the main point is just Bitcoin has kind of seen some sort of decoupling with risk assets, and particularly the Nasdaq actually. So Bitcoin, of course, digital asset is looked at in light of the technological aspect, and you can compare it to the Nasdaq, and typically they're very very correlated. However, when the market across the globe is faced with uncertainty and things are correcting, Bitcoin has held up very very well. So that's one big um, thing that people that are interested in crypto or just want to kind of observe should keep an eye on. I think definitely Bitcoin is maturing, so it was definitely good to see. Like all jokes aside, Bitcoin has definitely done very very well during this correction.
Yeah, I mean, I can see that it's held up strong, but then do you think this type of like decoupling or like correlation is that common for Q1? Is that something seasonal, or is do you think that's something new happening?
That's a great question. So we can actually look at the quarterly returns on average previously for Bitcoin, and the average was about 51.2%. But of course, that includes 2013, which was about 540%. So of course, it distorts the whole value. But mainly just looking at Q1, it depends if it depends on the context. So if we're in a environment where there's a lot of liquidity being injected into the market, i.e., lower rates, things like that, then of course Bitcoin has always performed very, very well. But yeah, so far in so 2023 was about 71%, 2024 about 68%, 2022, which was a bear market, was only -1%, and so far it's about -11%. So of course I'm gonna talk about of course with the statistical data for Bitcoin whether we're gonna see a sell and may go away again, what's gonna be what my opinion is on what's likely to happen for the performance of Bitcoin during Q1. But just to highlight the kind of decoupling speculation, really, because we don't have enough data to really suggest that Bitcoin is like matured and is kind of starting to decouple from the Nasdaq. So I think it's something to kind of observe, but it's on a very very short time frame. So we need to kind of observe this over multiple cycles to really make that distinction.
Hmm. Yeah, and final question on this before we move on to a similar topic, but which is FTSE and S&P performance. But how much of Bitcoin's performance in Q1 do you think is macro driven or was macro driven versus crypto specific? I know you're going to get onto crypto news, but just want to finish off this topic with that.
I'll say like if I were to give it a percentage, 80% macro driven, and then
Hmm.
maybe 20% crypto, or even 90-10 actually.
Hmm.
Especially Bitcoin. Perhaps different cryptocurrencies, that's a different conversation. But for Bitcoin, it's been very much driven by what's been going um, on the macro kind of lens. Even if we had like, pumps from the strategic reserve announcements and things like that I'll talk about, it's been sold off quite quickly, which was expected. I'm pretty sure I mentioned that on the previous episode, that it was not likely we're going to V-shape out of here, and that's exactly what's kind of happened. But yeah, it looks like we can start to shift the tide here. And I think I'll talk about that again later. But mainly, my kind of thesis around that is the global liquidity. So looking at the MTU liquidity against Bitcoin, is and kind of offsetting it by 105 days, it's kind of shown that the trajectories kind of one to one. Is like, without getting too into it, it's definitely something that I'm seeing that's kind of leading the pathway to how Bitcoin's reacting, and it's kind of predicted the price so far for the past few months. So that's very, very interesting observation I've kind of looked at to um, kind of give me a hit on the general direction for Bitcoin.
Yeah, and of course, all this we're going to discuss a bit further later on in the episode. But now to talk about FTSE versus S&P. Now, Dylan, earlier on in one of your responses, you did mention how they were both comparing, but to give like an overall summarized view, how did the FTSE compare to the S&P in Q1 2025?
Yeah, so as I mentioned, the FTSE's touched nearly 4% this year to date, and the S&P has contracted nearly 6%. And there's a few reasons for this. Obviously, I mentioned how undervaluations in the UK market is a big factor. And actually, we've seen a lot of asset managers actually reallocate a lot of their capital towards the UK because they're starting to see this undervaluation. So, for example, like the average PE ratio of the FTSE is nearing 15 to 20%, whereas the S&P's nearing 30 to 35 times. Sorry. So there, and I mean, there is a premium for a reason normally in the US market. That's because there's high growth firms and technology firms that have really sort of spurred on, like Nvidia. We've spoken about Meta, we've spoken about Apple, and they've had quite bad years this year. And obviously, that is primarily because of tariffs, but also because of these overvaluations. And obviously, we've had big tech sell-offs, and when we talk about things like DeepSeek, for example, we saw how sensitive these big US tech companies are to even the slightest of bad news. And you don't quite have that in the UK. The UK market is much more stable and resilient because there isn't as high growth. It's more sort of stable, contrarian almost. And another reason why the FTSE's displayed such good performance compared to the S&P is actually the pound. The pound has reached a 3-year high towards the US dollar, which signals, I mean, first of all, strengthening the economy compared to the dollar, which is obviously devalued a lot over the past few months, and obviously that is because of tariffs. So overall, really, I suppose it's a mix of valuation and sort of economic sentiment, and investors really shifting their money out of the US is what's really caused the FTSE to have such a good performance compared to the S&P. Now, do I think this will continue through on to the end of the year is a different question. Firstly, because the US is a market that will always stay resilient, and as I said, it's so volatile. So even though we're only into the first quarter right now, that doesn't necessarily say that this performance will replicate in quarter two, quarter three, quarter four. If anything, it will probably end up reversing, and we'll see a slight sell-off in the FTSE, and we'll see some more buying opportunities in the S&P. But for now, it's been a strong start to the year with UK capital markets. I mean, even accompanied by some big IPOs. We're talking about a potential Sheen IPO. We're talking about a potential Monzo IPO, Starling Bank IPO. And the UK is often criticised for not being able to land these big sort of public offerings. And when we're having domestic banks and domestic and foreign companies like these, it sends good signals to UK capital markets, and I think investors sort of prefer the much more stable approach compared to sort of Trump's volatile approach. So I suppose that's a brief overview of how the FTSE's compared to the S&P.
Yeah. To be fair, you've answered like all of our future questions on that topic. That was a very, very holistic overview of what's happened. So I'm going to stick with you when we move on to the next section, Dylan. And it's the big one. It's what we've been waiting to talk about and what we've been hinting at. So it's time to talk about Trump and tariffs. What a surprise. So, Dylan, I'm going to stick with you. What's going on with Trump and tariffs, if you can do it in 2 or 3 minutes? And what's specifically been said in Q1 that might have an impact on the next month or so?
Yeah, so repeat from this first term. Trump, as he calls it, the beautiful word, the most beautiful word on the planet, tariffs. He's introduced tariffs on pretty much the entire global economy, some higher than others. There's questions whether to how he's actually calculated the tariffs imposed on the US. I'm pretty sure he did it based on the trade deficit divided by something else and decided that countries are putting tariffs on the US, which, sums things up really. But yeah, so he's introduced tariffs, but I suppose the big thing here is China. So one thing that surprised me actually before I move on to that is how kind he was to the UK. So it was only a 10% tariff on the UK, which compared to Europe, I'm pretty sure was 20%. So considering his relationship with the current UK Labour Party, I was really surprised that it was one of the lower. It was just in line with the baseline tariff of 10%, which was a surprise. But he's gone completely guns blazing with China, and he's sort of gone back and forth. So he April 2nd, Liberation Day, announced 34% tariffs on China. And then China matched the tariff of 34%, and then Trump was talking about bringing it up to 125%, and then China responded again, and now we're pretty much touching 240% talks of tariffs, which is, a massive detriment. Like if you look at, for example, the Los Angeles Pier, which is meant to be one of the busiest sort of shipping ports in the Western world. On the ship maps that show cargo ships, it's pretty much empty. And this has forced a lot of companies to sort of shift their manufacturing away from China. For example, Apple, they've scrambled recently to change their manufacturing process to India. A lot of companies have spent a lot extra on inventory, so now they have a much bigger backlog, so they can sort of dodge these tariffs. And then Trump comes in and says, we're going to cut tariffs on semiconductors and chips and things like that, which is actually one of China's largest and one of Asia's largest exports over to the Western world is these chips, because you've got Taiwan Semiconductor Manufacturing and all of these big other companies. So he's gone back and forth, but a lot of companies have sort of been racing to reach a trade deal with him. We saw he met up with Italy. There was talks between the US and the UK reaching a trade deal, which surprised me, to be honest, because the thing is, what Trump hasn't understood really is the US doesn't hold as much power as it did before. And if you look at sort of the global countries' main trade partners in 2000, it was the US. Now, I'd say 85% of the economies around the globe, their main trade partner is China. So, I think he sort of implemented these and sort of brought this idea to life because he thinks he's from a position of strength, but he hasn't quite realised that the US isn't as powerful as it once was from a trade position. So it's been a really interesting month. We've seen, like I said before, the S&P's significantly declined, and he sort of keeps going back on his word and then coming back on it. But I think the main issue here is the US and China, and seeing sort of how that plays out.
Yeah, again, a very, very good overview. And I was going to add something more. Obviously, I think a few days ago, I don't know if you saw, but the whole Amazon thing about how Trump's press secretary was like, this is our political and hostile attack because Amazon has started listing on their checkouts for US customers exactly the how much the Trump tariffs are adding on to the final value. And it was quite funny when the reporter, you need to find the clip, bro, if you haven't seen it, but it was like, they literally, a reporter asked, like, what's your thoughts on it? And then the press secretary was like, yeah, I've just got off the phone with the president. I'm paraphrasing, of course, but I just got off the phone with the president, and what's the word? And she held up a picture of like an article that said, "Oh, like this is what Amazon's doing," and he's like, they've recently got like a China propaganda arm partnership or something, and she was just clutching at straws, and she didn't answer the question at all. Like, what's the thoughts on this? Instead, she said, "Oh, it just encourages Americans to buy American." She didn't talk a bit about how it demonstrates how the consumers are paying for it instead of how the foreign companies are paying for it, like Trump alluded to. But it's interesting times anyway. It's interesting times.
Yeah, and Trump's really been using these tariffs as like a weapon, hasn't he? I mean, you remember how it was between Mexico and Canada, and then you had he sent out threats for anyone who bought oil from like Venezuela. There was there was a few different things like that, and then now like the consequences are like slowly starting to creep through. He's all shocked, and his whole party is shocked.
Yeah.
But Jeremy, what's your thoughts on this whole tariff conundrum?
I said on the previous episode, it's like 5D chess going on. It's all for one goal: lower interest rates. Trump wants to pump markets. He wants the economy to kind of look good whilst he's there, of course. So while that's the goal, I guess his strategy is kind of um his first year in office, let the kind of market bleed, let things go bad first. So of course it's kind of like sour sweet scenario, and then at least long term he's going to be able to have a more sustainable kind of environment once interest rate starts coming down, and then the market start to react off of that. But yeah, we could look at Trump's comments, and I'm going to read out a tweet from Trump, and then we can kind of understand how he's kind of thinking. But yeah, he tweeted on Twitter, presentive cuts in quotation marks in interest rates are being called. So this is a tweet to Jerome Powell essentially, or talking about Powell and interest rates. And so he said presentive cuts in interest rates are being called for by many, with energy costs way down, food prices, and then in brackets including Biden's egg disaster, and then it says sustainably lower, and most other things trending down. There is virtually no inflation, with these costs trending so nicely downwards. Just as I predicted they would do, there can almost be no inflation, but there can be a slowing of the economy unless Mr. Too Late, so he's referring to Powell over there, and being too slow to cut interest rates. So unless Mr. Too Late, a major loser, lowers interest rates now. So he just goes on and starts talking about Kamala and these other things as well. But he's just like constantly ranting about the fact that he wants lower interest rates. And we can kind of summarize how he started out when he was referring to Powell. And of course, like April 7th, he made comments about Powell moving too slow. April 14th, he talks about um, somebody coming into office instead of Powell. And then again, April 17th, this is his exact words. Powell, like when referring to Powell, he was like, Powell will be out of there if he kind of decides he wants him out, right? Then, of course, he made a comment 2 days later, so April 19th, he's studying if he can fire Jerome Powell, which was just crazy. And then now that, now he's starting to negotiate with China and kind of understand the repercussions to some of these moves. He's now made comments literally so about 3 days ago about he has no intention to fire Jerome Powell now. So this is his exact words: I have no intention of firing him. I would like to see him be a little more active in his terms and his ideas to lower interest rates. So interesting games going on, honestly.
Add to that as well, one thing I find really funny about Trump's tweets is, I don't know if anyone's seen the video, he basically has someone next to him at all times, and they write down the tweets for him, and he basically just says out loud what he's thinking at the time. So he's sort of talking to them, and he's like, yeah, do it, get a tweet up, and they start typing, and he will say, Mr. Too Late to Act or whoever. I find it quite funny how literally his tweets are exactly what he is thinking at the time. It really puts it into perspective. That's why they're sort of so hostile and sort of straight to the point. It is exactly what he's thinking at the time. But yeah, it's crazy times, and I think, to be honest, sort of how Jeremy was saying, I think he will end up coming back on these things because it can't continue. Because what he fails to realise is a tax on the US at the same time. So I did actually see an article come up literally this morning, about 30 minutes before filming, that apparently Beijing is ready to actually have discussions with Trump about these tariffs, which will be interesting to see how that plays out. Obviously, he did reach the minerals deal as well. I think it was last night with President Zelensky in Ukraine, which is something he was pushing for. So it's interesting times. It seems that some things have actually really gone his way, and some things really haven't. But yeah, really crazy times at the minute.
Yeah. I think the whole, first of all, we're going to come on to more Trump versus Powell stuff later on in the section after the next. But it's just the whole thing how like the Fed is supposed to independently, like the Constitution, the whole thing in America is supposed to independently review sort of the economic state and then make judgments and make actions. And the whole point is that the president doesn't have a say, or that big of a say, firing the head. You can't do that. So, but obviously this is stuff that we expect Trump to be doing. And with Zelensky, I mean, we all saw that historic meeting at the Pope's funeral, which I thought was actually super dramatic. It was just literally two chairs in the middle of this massive room. You had the Prime Minister and the French Prime Minister just like on the sidelines and stuff. You had, I think the French Prime Minister like refused to shake Trump's hand or something. There's a lot of smaller, as you said, Jeremy, 5D chess. There's a lot of smaller pieces moving and then the bigger pieces as well. But to finish off this massive section, because we could talk about this for a whole episode, he did put a 90-day pause in for tariffs. For all the countries, I think, apart from China, correct me if I'm wrong, Dylan. But which parts of the market could be or would be most affected if these are reintroduced after those 90 days?
Yeah, so really the consumer goods market. I've got some data here saying that the increase in tariffs on consumer goods is expected to cost American consumers between 120 and 220 billion dollars per year. And he mentioned a lot of tariffs on sort of alcohol imports, particularly in the US. A lot of the alcohol that they consume is European alcohol, which will definitely have a major impact on companies like Diageo, who's had quite a bad year already. So definitely the consumer goods market, but then also the energy sector is quite a big one as well. There's been talks about less drilling globally because there's less foreign demand for energy, and apparently there's been nearly a 20% drop in oil prices because of Trump's tariffs. So it seems that energy and sort of consumer sectors have definitely suffered, and I think the tech sector will suffer as well, because at the end of the day, the majority of their sort of inventory comes from China and comes from the countries that have these large tariffs being imposed on them. And you see it with Apple. That's why they're sort of scrambling to, get their manufacturing over to India. They're ordering a backlog of iPhones so they don't have to worry about the tariffs for the time being. So I think that's definitely a big factor that comes into it. And also when you look at almost like social media networks and sort of these platforms as well, like if there's so many issues and trade wars going on with China, it's also a national security conversation as well. And obviously we've already seen what's been happening with TikTok and things like that. Is that sort of going to limit social media platforms? How is that going to affect these tech companies in terms of like Meta and Alphabet? So I think to be honest, nearly every sector is going to suffer. I really can't see a way out of it, but I think the main ones are definitely sort of consumer focused sectors.
Yeah, well, listen, that's a good way to end that section. As I said, I mean, to be fair, in episode 2, when we introed you guys to the new rebranded show, we spoke a bit about it there, and it just shows that we could talk a lot about it, and it's a very, very currently developing situation. So I'm sure there'll be more to talk about it in a month's time as well. But listen, Jeremy, I'm gonna move on to the next section, which is crypto news, as he said, and there's a focus on the Bitcoin Strategic Reserve that we're going to talk about, but also other bits and pieces as well. But let's start with the Bitcoin Strategic Reserve. Can you explain what it actually is for our listeners and viewers that just hear this buzzword in the media and don't know what it is? And why has it made headlines?
So yeah, the Bitcoin Strategic Reserve is just a way for um, different countries to get exposure to the Bitcoin asset essentially. So to kind of hold some Bitcoin and essentially combat the deficits that countries kind of face. It's a very, very intelligent way to do that. And of course, to kind of diversify into a new technology that less than 1% of the population actually understand. So, of course, it's extremely early right now. And there's not much people or countries, shall I say, that potentially have realized the potential of what Bitcoin can do and what it is. That kind of changed last year. Off of the back of Trump speaking about it, and now you're seeing countries like China, of course, and the US kind of taking it a lot more seriously, and we can even see kind of um, the level of importance that the Bitcoin Strategic Reserve has had, as we had like a massive kind of meeting in the White House with about I think it was 20 to 30 different major crypto companies and key industry leaders, and this was great to see because in the previous White House kind of elected individuals. So the Democrats essentially, crypto was looked down upon. There was no kind of developments to even, um, put the US ahead. There was no kind of technological developments when it came to Web3 and blockchain. So of course that was very good to see. Donald Trump was on there. It was actually a great stream to watch. There was even a FIFA coin mentioned. It was crazy. Like I was even scrambling to kind of find a ticker and see like what was going on. And yeah, like it was interesting. It was interesting. But on a more serious note, looking at some of the news around the Bitcoin Strategic Reserve, we can see that countries like China and of course Germany have continued to kind of increase their holdings, and we're seeing that the US had a problem with actually kind of implementing this strategic reserve since the inauguration. So there hasn't been an increase as of yet, but of course that was because essentially they can't kind of buy Bitcoin directly because that kind of implicates that the dollar is not um, as strong. They don't have as much confidence in their own kind of global reserve currency. So the way to go around that is they have to find a way to accumulate Bitcoin without using taxpayer money, essentially. So of course they call that budget neutral strategies. But of course, I think that there will be, different loopholes to kind of adopt more Bitcoin. But in the grand scheme of things, it's a great development in general to see that the Bitcoin strategic reserve is one way for the kind of institutional FOMO to persist, where a lot of countries understand the technology and they want to kind of accumulate Bitcoins.
Yeah, then kind of sticking with that then. Could you just talk a bit more about like, do you think that really changes the narrative around Bitcoin and Bitcoin as like a reserve asset or store of value?
Yeah, definitely. I'll say that, um, of course, the more the supply gets bought up from different institutions, different countries, and things, it's gonna be viewed more of a store of value, and we're kind of seeing these effects already. When these major corrections, typically Bitcoin was more, it responded more like a risk asset, very volatile. Major corrections, but even in this current correction, it's outperforming the S&P. It's outperforming a lot of different assets, apart from gold. But even recently, gold's starting to correct, and Bitcoin's starting to break out against the gold pairing. So we're seeing that Bitcoin has been looked at as more of a store of value at this time, especially with wars. We had Pakistan and India, um, two nuclear powerhouse countries, come out with some conflict headlines, and Bitcoin did not even respond to that. It didn't move down as much. We saw the S&P kind of react as it should normally, and then gold started to soar. But of course, it just shows that Bitcoin's responses to some of these kind of um, headlines, uncertainty is kind of starting to change. So, of course, one symptom might be the Bitcoin strategic reserve and the the forecast of Bitcoin's value ahead of time.
Well, we've spoken a lot about it during the episode. We've spoken about Trump versus Powell. As I said at the top of the episode, kind of the lack of camaraderie between them both, and just sort of the drama that we're seeing, as you kind of touched on, Jeremy, in that sort of tariff news segment, just about how much Trump changes his outward narrative of Powell and the Fed. So, Dylan, I'm going to come to you. For our listeners and viewers who haven't been following it that closely, what's the story with Trump and Powell? What's being said, and why is it being said?
So it really dates back to Trump's first term again, and it seems like everything is just a repeat of Trump's first term, really. But what people don't actually realise was he was the individual that actually appointed Jerome Powell as head of the Fed, and they had a really good relationship at first, and actually. Then all of a sudden Trump comes out and says that basically Jerome Powell was a bigger enemy to the US than China. And this is because of, first of all, there was a trade war with China in Trump's first term, and also he felt as though he was too slow to drop rates. And effectively, the same thing has happened again. So, Trump has said publicly, for example, we had a rally in Michigan, and basically said that he knows more about interest rates than Jerome Powell does, by saying, I know someone at the Fed who isn't doing a good job. And as we've sort of stated throughout the episode, he is currently looking for ways that he can fire Jerome Powell, which, to be perfectly honest and to put things quite short, it's not possible. They're a separate entity to the US government, and they should be able to act separately. But again, it's the same criticism as he had before. It's that Jerome Powell's not cutting rates fast enough, and basically, the reason why Trump doesn't like this is because he's a firm believer of having really low interest rates to spur growth. And he thinks at the moment 4.25 to 4.5% is way too high. Trump being a sort of hostile and straight to the point and almost radical as he is, his first thought is, right, how can we force him out of the job, which I don't think has ever really been done before. So that's the main sort of consensus of it. He wants Powell out because he wants rates to come down, and he thinks that Powell's too slow to act. Powell's side of things, that with Trump's economic policies and with current inflation rising, he feels as though this is a bad idea. He said in an interview recently, he has fears for the US economy in terms of growth and doesn't see a strong outlook at all. So it's basically they're just clashing heads with two entirely different viewpoints, and it's become quite a sort of public feud, and it's turned into Trump looking for legal ways to get him out. So yeah.
I think I read somewhere like Trump is just waiting for 2028 to come around so that Powell can go out. But as you said, him bringing any significant change is probably minimal in that aspect. But do you think Powell or the Fed feel any like political pressure, or do you think it's just campaign noise?
To be honest, I remember Powell saying in his interview that he does not let Trump influence his decisions, and to be honest, I think that's rightly so. And I think if they really felt the pressure, I think they would have dropped rates sooner and taken more action. But to be honest, they've held firm and sort of stood their ground, which I think investors wanted to see. Because one of the main criticisms of this really is how bad does it look when you have the US Federal Reserve and the US President, at a public almost beef, when you've got things going on here on a global scale. How weak does the US look to China right now, and to Europe and to Russia? First of all, it's bringing like instability to the US markets. It doesn't look good for outside competitors. So I think really Powell and the Fed sort of standing strong really displays the fact that they're not going to allow Trump to dictate their decisions. And I think, to be honest, rightly so, because as we say, the Federal Reserve should be able to act independently, and in the sense that that Trump's trying to force them into making his decisions, that's almost a dictatorship in a way. So I think they're standing firm, and I think rightly so. And I don't think they're facing any specific pressures. I think they'll drop rates when they need to, and they'll raise rates when they need to, without any external sort of opinions.
Yeah, and that whole thing on instability, because it kind of links back to what you said earlier about how people are like swaying away from the US. Because if you go to the world's largest capital market, you'd probably search for a bit of stability, wouldn't you? So, but yeah, it's all over the place. But to move on to the next topic, then, talking about the statistical data for Bitcoin. Now, looking beyond price, what are the key Bitcoin metrics or on-chain stats that in quarter one that have stood out, Jeremy?
So yeah, just looking at kind of the response to the correction, and then of course the rebound. So Bitcoin's up almost about 30% so far since the kind of dip to 75. So of course that was it was a good response. V-shaped recovery really has kind of recovered a lot quicker than everything else, even Ethereum and different altcoins. So of course it kind of highlights the fact that Bitcoin's kind of looked as more of a store of value is kind of being priced differently as opposed to some sort of risk asset where you look at Ethereum and it's being priced as a risk asset as it should. Of course, you can look at the Ethereum against Bitcoin valuation too, and it hit almost all-time lows, never seen before since the 2020 kind of lockdown. So of course, yeah, it's a key kind of area where maybe um, Ethereum and different risk assets can start to kind of rebound after such a deep correction. But of course, the macro kind of decides that, in my opinion. Definitely, the up and coming FOMC meeting is gonna kind of set the pace. But yeah, just delving into some of the statistical data a bit more. Like for Bitcoin, we're seeing the OTC desks Bitcoin balance start to just decline. Like it's been declining since 2022, like straight line down, and it's in and around 100K, which just shows that the available supply for Bitcoin is just continually decreasing, which is just shown in the price. It's been absorbing dips very, very well. And of course, it's kind of rallying even kind of higher. So the risk adjusted returns for Bitcoin has been extremely, extremely good. And of course, looking in towards the funding rates as well for Bitcoin, it's an environment right now where it's a lot of kind of spot buying. It's not really driven by leverage and kind of open interest just rising due to um, kind of speculation per se. It's kind of people buying, believing in the underlying asset. You can see the ETFs about 42 billion in about 12 days. So yeah, that's BlackRock buying a lot of that. So you can see that there's a lot of kind of demand for Bitcoin. Now looking at the kind of potential direction where Bitcoin can go, we can see that if you look at the short term on chain cost basis, which is essentially the price that short term holders has paid for their Bitcoins, we've kind of reached the exact point where they're starting to be in profit now since Bitcoin's rallying. So Bitcoin's around 95K. So I'll just quickly check. So yeah, wow, it's almost around 96K. And essentially, it's just continuing to perform very, very well. And short term holders are now in profit. So that just shows that the kind of mindset behind or their sentiment, sorry, in the market now. And typically, when the short term cost basis flips positive, then market participants kind of are more open to taking more risks. And this can lead to further increases in price due to them kind of adding more. So that's something that's kind of just flipped now positive, and we can kind of see that maybe sentiment might shift and we may come down for a higher low, and Bitcoin can definitely start to move a lot higher. And I do think it's possible that Bitcoin can make a new all-time high very, very soon. And the one kind of thesis behind that is the global liquidity. So we can see that the M2 liquidity offset against Bitcoin for 105 days um, is at all-time highs right now. and it's identical to the Bitcoin price. Like I done a YouTube video on the day that we were at 75K, and so I publicly sold at 92 and I bought back at 75, like the exact kind of bottom. And that's just looking at the global liquidity. And right now it's at all-time highs. So I think it's possible that we can see all-time highs for Bitcoin, given Trump continues to kind of calm down, essentially, because that's kind of led to this rally that we're seeing. So that's kind of some observations looking at the short-term holders. Now, just some last kind of closing thoughts. Looking at the sell 'em in, go away narrative. So we can look at the monthly average for Bitcoin. So on average, every May since 2013, it's been quite flat for the Bitcoin performance. So yeah, it's definitely something that may be a symptom of people selling to kind of pay their taxes. There's a lot of different verticals we can go down, but the kind of key point is that it may be a month where um, not just Bitcoin, but of course the S&P 500 as well. It may be quite turbulent, but of course moving in towards the summer and in towards the later stage of the year, I do think that um, the market is definitely going to surprise us. I do think that we're going to start to rise very heavily, but for the next 30 days or so, well, until the next kind of monthly recap, I would not be surprised if we start to just see a correction. Of course, that's not my base case. I still believe in a M2 global liquidity, but yeah, like to kind of summarize it, because I'm thinking of different points at the same time. Um, Essentially, I'm kind of just operating under the mindset that all time highs are possible. All time highs are definitely possible. Looking at what's happening with the global liquidity, but historically, the time that we're in now, it may take a little bit longer where we continue to just chop between the low 80s and the high 90,000s for Bitcoin. And then maybe later on, we can start to push the all time highs. But I continue to remain extremely bullish on Bitcoin specifically. As for Ethereum and different altcoins, I think it's a thing where they're only going to rally when monetary policy shifts, and we kind of see the risk appetite come back into the market. Um, like a quick kind of stat, we're seeing the Google search term for Ethereum and altcoins at all-time lows, lower than the bear market, which just shows that there's literally no kind of retail coming into the market. So it's literally just institutions kind of propping up the Bitcoin price. And as for altcoins, they continue to bleed against Bitcoin, which just shows that it's quite wise to be Bitcoin heavy at the minute until the context definitely shifts later on.
Hmm. I always like starting off, as I said, with macro news and then ending off with that sort of, or close to ending off with that more specifics on Bitcoin. But as you touched on, that was a very breezed through sort of summary of statistical data for Bitcoin and some of the other coins as well. So if you want to hear more, please sure to check out Jeremy's own personal YouTube channel, Jezza BTC, linked in the description, where he goes into a lot more detail, not just summarizing it in one question for us on the Smart Money Show. But listen, Dylan, last topic of this recap of Q1 and of April as well. So bank earnings. How did the major banks fare this earnings season? Any big beats or misses? Talk to us.
Yeah, so obviously, as we talk about with banks, especially in their trading division, volatility is always a boost. And I mean, that's echoed towards all of the major bulge brackets. This year, we've got Goldman Sachs. Their revenue was 15.06 billion, up 8.6% over the quarter, and revenue from global markets rose 26% with record equities trading revenue. Again, we will go on to JP Morgan. They're up 9% over the year in terms of net income. And again, trading revenue increased 21% with equities revenue jumping 48%. We'll move on to UBS. Global markets revenue up 32% year over year, driven by equities and FX trading. We look at Barclays as well, 28% year over year increase in their pre-tax profit, and trading revenues up 9% in terms of equities, and fixed income up 21%. So the key trend here I've seen with the big banks is investment banking revenues has dropped in terms of advisory decisions. One notable one being Goldman Sachs, where David Solomon actually told their clients to go slow due to these tariff concerns, and he said that he expects more deal flow towards the end of the year in terms of investment banking, which, to be honest, I agree with. But really, the whole idea that volatility is the bank's best friend in terms of their trading division has came true here. They've all smashed earnings, and that is driven by their record revenues in their trading divisions.
And well, you can't discuss a common theme across these reports, but how did markets react differently to US versus UK bank earnings?
Both UK and US actually had a very similar reaction. We saw JP Morgan Chase, they were up 4% on the day. Barclays were up 3.4% on the day. We also had HSBC Group, who were up 2.9%. So it seems that the consensus is relatively strong for the banks, and there wasn't too much of a discrepancy in the reactions. Both the UK and the US market had favourable impacts.
Amazing. Well, lads, it's always been a pleasure to chat to you, and it's great to be back on the recap episodes. And obviously we had a lot to cover this episode, the whole of a quarter, but from next month onwards we'll be covering just a month, but there's a lot to look onto in the next month, so I'm looking forward to the end of next month again when we can cover this recap episode. But I hope for our listeners and viewers you guys learned as much as me and Noah did from that, and I hope you enjoyed the episode. And if you are watching us on YouTube and for some reason you haven't subscribed already, then please be sure to hit that subscribe button so you don't miss any of our future content, including some of our medium form videos which will be launching very soon, explaining exactly how you can break into financial services as a student. And if you listen to us on an audio platform, then please do the same. Drop us a follow, drop us a comment, drop us a rating, whatever you want, to let us know whether you liked the episode or didn't. And feel free to let us know if there's a guest we should be talking to that we haven't talked to yet, or something we should cover that we haven't covered yet, or something Jeremy and Dylan got wrong. I'll be very, very happy to pass that on. Trust me. But please do follow us on our social media platforms as well. We announce a lot of events on there, hiring for new interns for the team and other bits and bobs as well. And we have just launched our newsletter and articles, which will be linked in the description of this video. So for more in detail insights of these topics that we've covered on this episode from our own host and team of research analysts and equity and crypto teams, then you can check that out in the description below. But as usual, thank you so much for watching this rendition of the Smart Money Show, and we'll see you next week for another episode. Take care, and please stay tuned.